Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at E.L.F. Beauty, one of many stocks to fall 35% or thereabouts in the last couple of days. The market is correcting a little bit, looking at some of these high growth names. If they even have a sliver of a miss, whether it's on actual earnings or on guidance, it's punishing them heavily and returning their valuations to something more reasonable. Stock is down another 7.8% today after being down 35% yesterday. In the last year, this has been a stock that's been up and down. It's kind of in that range of 50 to 130, 140. It was in the 140s just at the start of this year, fell into the 50s after some disappointing growth numbers. Acquired Rhode seemed to start growing again, and now the earnings are a bit disappointing and the stock is in free fall yet again. And Rhode is really one of the bright spots in this earnings release. This is a brand they bought in May. The deal closed in August, so only about 2 months of the revenues are reflected in the earnings release. They paid $1 billion for it. It's $800 million plus $200 million in earnouts, but at $1 billion, you're looking at about a 4.7x multiple to sales based on the net sales at the time. Now they're guiding for about 40% growth for this brand, so you're looking at about a 3.3x multiple. For a brand that's growing at 40%, that's not too bad when you consider that that's what E.L.F. Beauty is trading at right now, and their core business isn't really growing at all. And the core business not growing is really the issue here, why the stock is down so much. You look at the net sales up 14%. That doesn't sound so bad, but you have to also consider the fact that in August, they added the Rhode brand. The Rhode brand had about $52 million in sales during this 2-month period within the earnings timeline. That means that their core business shrunk by 3%. So that's a big shift from what was happening within this business in 25, 24, etc. This is a business that grew at 28.3% organically within their core business to now shrinking without Rhode. And that really shocked investors as to how fast that core business decelerated. And then also, as you look at the guidance for 2026, the net sales guidance, 18 to 20% increase in net sales, which again, sounds good, sounds pretty comparable to the 28%, sure, some deceleration, but you have to consider that Rhode is going to make up the majority of that. You're talking about 8/12 of the earnings period being affected by Rhode, probably going to have about 16, 17% of the impact to net sales that they're showing here. So their organic business is probably growing closer to 2 to 3% at best. Again, huge deacceleration from the 28% we saw last year. So that is really driving the re-rating we're seeing in the stock. And the other issue here is that their margins are being squeezed quite a bit. Gross margin down about 190 basis points to 69%. Still pretty good. But a lot of that is driven by higher tariff costs that they're seeing. Those were anywhere from 45 to 150% because they make a lot of their stuff in China. So depending on when they were making this product, their tariff impact was pretty large. So overall, their cost basis was impacted by something like 35%. They did pass on a $1 price increase across the board. That will offset some of that, but at the end of the day, you're seeing pressure on the margin side. You look at adjusted earnings per share going from $3.39 in 2025 down to $2.85 in 2026. So you're seeing margins being squeezed quite a bit on the net income side. One thing to note too, diluted earnings per share are very much adjusted here. They do have a decent amount of stock-based compensation. There's some non-reoccurring stuff that seems to reoccur every single year. And then they're removing depreciation and amortization as well. So I find these a bit funky, so I wouldn't look at these too closely. I generally prefer to look at things from a free cash flow basis because you can do some weird shenanigans like remove, the $80 million in stock-based compensation they're going to have in 2026 and count that as a adjustment to your earnings per share. And that just, it's a real cost. You can't just remove that. And then another thing to note too, as you sort of think about the slowdown in sales for a company like E.L.F., you have to remember that they book their revenue when they ship to the stores, not when the customer buys their items. So their claim is that, hey, we stocked Target. We expanded in Target. We stocked a bunch of Dollar General stores. So we sold all of this stuff last year. That grew our earnings quite a bit in 24 and 25 because we were taking shelf space. We were taking market share. But once those shelves are stocked, you're not getting that initial rush of purchases from the stores that drive revenue. You're just getting restocking when customers eventually buy their items. So their claim is, hey, we are sort of in a spot where we are currently restocking stuff, but we don't have any major stores that we're expanding into yet outside of maybe selling Rhode at Sephora and things like that. But the customer and their purchases of our items is still pretty healthy. That's growing at a decent clip, and that's going to translate to overall revenue when those stores start to restock based on that consumption that they're seeing on the customer side. And that's a great explanation and all of that, but it's really not showing up in their guidance that they're giving for Q3, Q4, or anything like that. So I think the reality is that Rhode is going to be the driver of growth here, and that's what they're expecting. And their core brands are probably just slowing growth faster than people expected. So how do I value something like this? And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. I'm just a random guy on the internet. Here's my spreadsheet that I will share with you in the description down below. Hit file, make a copy to use it. Again, this is a $4.1 billion company after today's sell-off, with about $700 million in debt due to that acquisition of Rhode. Enterprise value of about $4.8 billion based on 2025 free cash flow actuals. It's still about a 2.7% free cash flow yield, which again, given the growth, maybe isn't that crazy. On a forward basis, you're closer to 3.1%, but again, it's tough to tell what their free cash flow is going to be like with the margin pressure they're seeing in 26 and how long that will last. And as you look at the growth here, you have about 18% based on their guidance. You can obviously go higher for 2026. I'm more on the bottom end, but if you want to go higher, you can. Let's do that just for fun. Then 27, about 18% growth. A lot of that is still going to come from Rhode. You look at 2026, you're only going to get about 8 months of a growing brand's revenue. You're going to see more growth going into 2027, and then you'll have a full 12 months of revenue from Rhode. So really this 18%, it probably just means you need 5 to 6% growth from the core brand. So if they can do that, they can certainly do that. The question becomes, what happens in 28, 29, 30? Is 12% too aggressive? Is 7 and 5% too aggressive? For me, that seems reasonable. Rhode seems to be growing pretty well. It's going to become a bigger part of their business. Hopefully that's not a one-time thing where a lot of these influencer brands kind of get hot and then sort of disappear. If that's the case, then maybe that's the problem for E.L.F., but I don't see it just yet. From a margin perspective, 8.5% kind of in line with last year, this year, so maybe that's a bit aggressive, then growing to about 12% by 2030, fiscal year 2030. I think that's kind of a realistic, more mature number for them. If you look at Estee Lauder, some of those other brands, they're kind of in that range as well when tariffs aren't a huge thing. You know, tariffs are going to be the primary driver of what happens here. How long do they stick around? The Supreme Court is looking at that. Are they even legal? Who really knows? We'll see. But law or anything that kind of gets rid of tariffs for a company like E.L.F. is going to be a huge thing and hugely beneficial for a lot of these consumer-based brands. When we look at their free cash flow, what are they doing with it? They did seem to start a stock buyback plan in 2025, so I have half of their money going towards that, but really it's just being used to offset their stock-based compensation. They had about $71 million of that in 25, growing from 24. They issued more shares for the Rhode acquisition, so some dilution there. So I think at the end of the day, they'll use some money towards buybacks, maybe another acquisition here and there. I think the idea here is eventually to grow a bigger house of brands. Obviously, the Rhode acquisition isn't their last one. They have the free cash flow to acquire more companies in the future, and their balance sheet isn't too bad right now. They'll pay off this debt that they got from Rhode, but they are generally cash flow generative, so that's not going to be a huge issue for them. As far as valuation goes, again, this is a company that's starting to slow a bit. You know, Rhode provides them with a rope of growth that they're going to use to climb a bit further. But what happens after that? What happens to their core brands? Are they really slowing, or is this just a temporary dip in regards to the sales they're making to their customers, which is the stores that stock their brands? And I don't think this is the end of the world. You know, I'm still assuming relatively decent growth for the next couple of years. But as they mature, the growth is going to get slower and slower. You're talking about mid-single digit growth for a while as margins get more mature. What's the right valuation for something like this 5-6 years from now? I think a 5% free cash flow yield is about right, which at today's price point gets you about a 6.7% return, accounting for buybacks and the growth you're going to get from margin expansion and revenue growth. They're going to use cash to pay down debt, buy back shares, etc. But a 6.5% return at this level isn't all that amazing. If you get to a 4% free cash flow yield or a 3% free cash flow yield, which is kind of where this company has traded, but that was on the basis of really amazing growth, you start getting into that mid-teens return. But I feel like that's kind of expensive unless you believe that this is going to continue growing in the mid-teens for more than I do, more than the 2 to 3 years you have with Rhode really driving a lot of that growth. So at a 5% free cash flow yield, future valuation, and a 10% target return, you get closer to a fair value of about $60 if you're targeting a return of about 15%, which again might be what you want for a consumer brand that can be very fickle in terms of what people are buying. You get to a fair value of about $48. So I feel like that's the right range. Something in that like high 40s, low 60s range seems like a fair value for a company like E.L.F with all of the unknowns. Again, the consumer might be struggling a bit. The economy's not amazing, but people are still going to wear makeup. That's one thing that people don't really give up. And the nice thing about E.L.F is that it's one of the cheaper options. So if people are looking at their makeup counter and saying, well, I use this brand from Sephora that's very expensive, I can maybe get something from E.L.F or one of their brands, whether it's Rhode or whatever, at a much lower price point that's 80 to 90% the quality that you get from some of these other more expensive brands. So I feel like that's really E.L.F's key aspect. If you want this to work, you have to believe that this is an investment that's going to attract consumers that are buying down but still wanting to wear makeup, and that's kind of the thesis here. And I think that's reasonable. If the economy does struggle, people will buy down to cheaper things, and E.L.F is right there. It's not the cheapest thing, but it's one of the cheaper available options, and the quality is pretty good from what I hear. So that's my take on E.L.F. What do you think? Am I missing anything here? Am I wrong on anything here? Leave a comment down below. If you're new here, subscribe to the channel for more super awesome videos like this one. And as always, thanks for watching. Have a good day, and bye.